Now you'll recall from the recap that I was talking about three different types of mortgages. A paper, which were the prime mortgages, and they were relatively reliable in terms of investment quality. Alt A, which were okay, and subprime, which were completely risky. Remember how I was talking about fixed rate mortgages? These were mortgages where interest payments were reduced as principal was paid down. The thing about fixed rate mortgages was that once an interest rate was set, let's say it's 8%, this mortgage would lock into it. So you couldn't change it. This generally meant that if you had a traditional mortgage, let's say that it spanned 30 years, as in this diagram, the amount of money that you paid each month would be the same. As you can see from the diagram, every period the mortgage payment is the same regardless of the changes in interest and principal. An alternative to a fixed rate mortgage is what is called an adjustable rate mortgage. These were mortgages where the interest rate adjusts according to an index. So adjustable rate mortgages, or ARMs, are considered good to have if you think that interest rates are coming down or if interest rates are low, because then you're paying very low interest payments. And as you can see here, as opposed to the diagram with fixed rate mortgages, the monthly payments are much smaller. But they're risky if interest rates start to increase, because this would cause monthly payments to increase significantly. But remember how the mortgage pool was opening up to borrowers with higher risk, mainly subprime borrowers. Well, many of these borrowers, because they did not have the same characteristics of prime mortgage borrowers or A-paper mortgages, did not qualify for a traditional mortgage. So that's when banks started pushing more unconventional types of mortgages. These included things such as one type of unconventional mortgage was known as a balloon mortgage, and these were mortgages where a family or homeowner would pay a small amount of principal and interest for the first couple years, and then for the final years they would make a huge payment, which was usually the remaining principal. That's why it was called a balloon mortgage. Unlike other mortgages, balloon mortgages are expected to be paid off in a much faster time period, like 5 to 7 years, although there are balloon mortgages for 15 years. Another type of mortgage is what's called interest only, and this is where for the first 5 to 10 years, a family wouldn't have to pay the principal for the mortgage. They would only have to pay the interest portion, and then after the period of interest only expires, then they have to start making payments on principal. Another type of mortgage was called negative amortization, and this is where a borrower did not have to pay the full initial payments for the initial years. Because they're not paying the full interest payments, the result is that the money adds onto the principal, and the principal gets larger. The risk with negative amortization mortgages is that a house that you bought at a certain price might end up costing more than what you originally planned for because of all the money being added to principal. These exotic mortgage products and adjustable rate mortgages became very popular over the past decade for risky mortgage borrowers because for the first couple of years the monthly payments for them were all low. But there was a risk. Even if there were low monthly payments, families knew that in the future the monthly payments would change and they would have high monthly payments. So why were they so popular? Well, their popularity was attributed to the fact that housing prices were rising. With refinancing, families had the option of getting a new mortgage deal before monthly payments got high. And the way this worked is, let's take this situation where a family has an adjustable rate mortgage from this bank, and so they're giving monthly payments, but they know that interest rates are going to go up. So what they do is they go to another bank and they refinance towards a fixed rate mortgage, and they'll probably have to pay a fee for changing this mortgage. But what this bank will do is that it will give this family the full money for the house, and that family will give that money to bank number one. So bank number one is out of the picture, and the family starts paying bank number two for the value of the house. Now, why was there such a large housing boom In other words, why were housing prices rising like crazy over the past decade until recently? Well, we talked about this. The mortgage pool was opening up to borrowers who were no longer just prime. And this increased the number of people who wanted houses. And because there were more eligible homeowners, that meant there was a huge demand for houses, more so than there was supply. The high demand for housing meant that housing prices were rising, and many erroneously believed that housing prices would continue to do so in the future. When interest rates went up, a lot of subprime borrowers who were not even qualified in the beginning began defaulting on their mortgage payments. This meant that they could no longer pay for the houses that they got, and they had to give them back to the banks. Banks had factored some of this risk in mind when they had given loans to these riskier borrowers. What they didn't anticipate was such a large number of people defaulting on their mortgages. The result was that there was suddenly a lot of houses that were available on the market for selling, but not a lot of buyers. And suddenly, there was a larger supply of houses than there was an actual demand for them. This caused housing prices to fall. In the end, when the value of the houses started to fall, this meant that investment banks were no longer receiving those small stream of payments that they were expecting every year. Instead, they were stuck with houses that were worth less than the money that they had originally paid for them. So, here were investment banks left with undervalued houses and losses of billions of dollars. To review, many people were not worried about problems associated with mortgages because housing prices were rising and people had the option of refinancing. When interest rates went up and borrowers defaulted, housing prices fell. This caused banks to lose a lot of money. Coming up, how did the situation with interest rates affect our economy? Thanks for watching. To learn more or watch more podcasts, visit www.subprimethemusical.wordpress.com.